And so this one's probably for Howard and Mike. So the IPO market is probably an exit, in some ways, an exit opportunity for you both. And I suspect you may bring up SPACs and direct listings because those have definitely been in the news a lot. Are you seeing within your funds IPOs or SPACs representing exit opportunities, or are you not really participating in that area?
Yeah, just a couple thoughts on that. Am I coming through okay? First of all, in IPO, the recent trends, if you're as old as I am and you look back to the 60s, there's been tremendous peaks and valleys in the IPO market. 1969 was probably the greatest year in the history of the country for IPOs. And then the 70s was probably the deadest decade in the year. Some years there were 15 or 17 companies going public, which is kind of happening per week or every other week here. And then the 80s with Apple and Genentech started to really explode. And then you had a lot of cycles. So this cycle, I don't think is any different than prior in peaks. What distorts the data a little bit, and Mike and I will talk about this, is the explosion of these special purpose acquisition corps, which really ballooned the data. You said 900. There's probably 400 SPACs in there. I'm just guessing. So the data's a little skewed because of this SPAC phenomena, and it's really a phenomenon. I mean, if you read your paper this morning, Kevin Durant decided to announce he's doing a SPAC, joining LeBron and everybody else. And if you, I won't explain SPACs, but for us, it's they're an exit release for us. There's a way to sell one of our portfolio companies into the SPACs. It's great for us because there's so many of them, and they all have a time deadline when they have to make an acquisition. So the later they are, the more desperate they are, they'll pay up for our companies. There are a lot of people in our industry, Mike and my industry, are creating their own SPACs. And you can get into a debate. I've never talked to Mike about it, and I don't know how many institutional investors are here, but it's kind of, to me, it's a huge conflict of interest and something that shouldn't be allowed to happen, because we're all paid to invest capital, and now people are creating in our industry their own entity, raise capital to do more investment. It doesn't make sense to me, but we love selling into a SPAC, and we've never done it, but we're in the bottom of the ninth inning with one out on a SPAC exit for us. One of our larger companies, over 100 million of EBITDA, and we're getting a value that we couldn't get through any other exit alternative. And it should happen in the next few weeks. So SPACs for us are just another one of probably a half a dozen exit opportunities. Pure IPOs, we've made 120 investments in 23 years. 3 went public. So it's very rare for us. And it usually is some kind of special story. We were the initial investors, and this isn't what we do for a living, but one of our biggest hits was Five Below. We invested in Five Below. We were the first institutional capital in Five Below. And, we're the idiots who sold out in the IPO at about a $400 million valuation. Today it's 6 or 7 billion. So anyway, IPOs are rare for us, but we're at the low end of the food chain. We're creating companies that sell to bigger private equity firms or sell to strategic buyers. And we can get into, I can talk for an hour on this, so I'll turn it over to Mike.
Yeah, we have a very similar theme, Graham. We're at the ninth inning of 2 SPACs. One should de-SPAC on the 1st of December, and one should be sort of the middle of December. I'll talk about it in a second. Like Howard, we actually consider doing a SPAC, and it's alluring. If you look at what the sponsor economics are, you basically should make 10 to 12 times your investment rather easily, regardless of how it turns out for the actual company at the end of the day. We came to the same conclusion Howard did. We just felt that it was a bit of a conflict of interest, and so we declined. We said, no, we're not going to do it. But we evaluated it all summer for it. Now, in terms of the 2 SPACs that we are doing, we viewed it as a financing opportunity, but what was very critical to us, we had one company that had 12 bids, another one that had 8, all from SPACs. And we didn't take the highest offer, but we took the offer that we thought had the best composition of cash, investments, et cetera. Then you go through the whole pipe process, which is another gate. Our pipe, fortunately, was led by Fidelity in the one SPAC that I'm involved with, and then got upsized after we had thought we closed it. The investors asked to add another 25%. So if you look at the cash on the balance sheet, there's going to be almost $450 million. Of course, that depends on how much redemptions there are for the initial group that went public, which is all these things you sort of calculate and try to underwrite when you're in the middle of it. We have never taken a company public. We did buy a stock in a public company. Many of you know of the name of it. It's Nutrisystems. It's ages.
Greatest investment ever done in Philadelphia. 62 cents
Yes.
to $80.
Yeah, it was a
Do
good
the
outcome.
math.
Howard and I used to teach a course about it
Right.
with at Penn Law.
We're the idiots who turned it down and referred it to Mike. So
They did. Seth,
Right.
Seth referred. Thank God.
we didn't like the
I said
food.
yes, supposedly on the third page.
Right,
Yeah.
yeah.
But I will tell you, though, it was really odd. You know, the company got to $780 million of revenue, $170 million of cash flow. And for the last 6 quarters of board meetings, we talked about our stock price, not about how to build the company. I thought it was the most, when I got off the board, we were sold out. It was a great outcome. It just, the bittersweet piece of it was you spent more time talking about activists, shorts, and you don't talk about building the company. So you really have to know what you're doing. I found it to be a pretty thorny environment. So I'll be interested to see how these 2 SPACs will do, because I'm staying on the board of the one.
Yeah, well, that's really interesting. Ed, I want to shift gears a little bit, but just thinking about these liquidity events that IPOs or SPACs represent, and just thinking more broadly about liquidity, for your clients, and how patient they are as investors. Looking at the difference between public markets and private markets for liquidity. Is that a conversation that you have with your clients? Are they worried about that, or are they so patient that they're fine with being locked into a 10-year private equity fund or whatever closed-end fund?
Yeah, actually, almost the opposite. So, our client base is ultra high net worth, and so we're talking about generational money, and we're a lot of the assets that we manage are in perpetual trust that are skipping generations. So we've got the opposite issue. We don't want our money back, and actually we talked a lot about and having PE fund that are perpetual. One of the issues in the business, and again our model is a little different. We don't charge a carry. There's no incentive fee, so we don't have an incentive to have an exit. And what happens in the PE business is, the only way they really get paid is to have an exit. And I'd ask the question, how often are those exits timed to the liquidity needs of the fund versus the best opportunity for the investment you make? So more and more and more, as our business grows, we're doing control private equity investment that we own and control, or we're doing deals with sponsors where we have the ability to buy them out because they need an exit. So liquidity for us it's the opposite. So there's a great firm in town. I don't know if many people are familiar with Berwyn Group, and they took that model. There's a very wealthy family, and they took the model of owning the whole business. They don't want to invest in a private equity fund. They don't want to invest in public equities. They just buy entire businesses. And they do run and manage the portfolio, but the decision to buy or sell is really based upon fundamentals and their belief of the future. So our liquidity is, it's almost perverse for us. It's really hard to find a great investment. And then if they give you your money back in 5 years, like, oh shit, now I got to go find another one. So for us, if we could, and there are obstacles in the business, as everybody knows.
That's absolutely true. I remember when we were raising our second fund, it was easier because we had Nutrisystems, which was publicly traded, so we weren't as worried about an exit. But in Fund 3, we were worried about exits. Now we're on Fund 5, and our other strategies are on Fund 4. there's less pressure to feel like you have to return because you have a track record of having done it. So you try to optimize for the highest potential price and liquidity given the circumstances. But there is always pressure to create liquidity and get points on the board because that's our job. There's no doubt about it.
You know, it's funny. Our business has changed as a public equity manager for tax-exempt institutions. We are required to provide liquidity. That is, we've become the checkbook for our institutions. And so one of the biggest things that we think about in this is how are we going to be effective at providing that liquidity via navigating the transaction costs and the trading costs that we have to face. So it's a careful dance that we end up having to play around that issue because we've essentially, like I said, become the checkbooks for our clients.
Yeah, I'll just add one other thing. Mike, I don't feel the pressure at all to get a liquidity event. I think the fact that we've been around for a while helps that. And, you know, these funds, I mean, I was just telling Mike before we started here, our second fund in 2004 is finally going to wrap up this year. So 17-year run. But you do, it's a different kind of investment thinking process. I mean, a Buffett or the Berwin family, Graham Berwin, when he was alive, they're thinking forever. And we can think long term, but for us, forever is maybe 10 years. And we've owned businesses for 10 years. So we have a lot of runway to create value, but it's always nagging there. Our LPs never say, hey, sell. They don't want to be involved in that decision, and they're not as anxious as we think they are. But we have more of a 10-year horizon when we think about stuff than a forever horizon.
I want to thank our panelists. So for those of you who are not familiar with the Philadelphia investment community, these are 4 of the best minds when it comes to investments in Philadelphia. So thank you. If we can give them a round of applause.
Pleasure doing it.